were able to go and take over $1 million out of his pension, not his 401k, out of his pension, let his wife convert that to a lump sum IRA rollover, and then start doing the Roth conversions literally from his pension.
Wow. Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have Marcus Foote. We're going to be diving into a really interesting 401k loophole called the In-Marriage QDRO. Marcus is a partner at Kuhn & Foote, APLC, where he focuses exclusively on community property divisions, military divorces, and qualified domestic relation orders, also known as QDROs. Marcus also serves as a consultant for attorneys throughout Louisiana, advising in niche areas of community property and strategic planning, retirement plan valuations, preparation of retirement division orders, and military pension benefits. In 2013, he developed the process that would ultimately become known as the In-Marriage QDRO. And since 2018, he's been successful in executing these in 34 states. Today, we're going to dive into what the QDRO is, who can benefit, and how you can learn more. Marcus, welcome to the show.
I appreciate it.
It is. Yeah, it's great to have you here. And I'm excited because this is a topic that I personally want to learn more about. And I think the audience probably has have their attention here. Today, we're going to be talking about the In-Marriage QDRO. And there's, what's interesting to me, I love the tax code. Some people are scared of the IRS and the tax code, and I like to see it as a rule book. And today we're going to talk about one of the IRS rules that, investors, people can take advantage of. But before we jump in here, Marcus, I'd love for you to share a little bit about, your background, and before we start talking about what the QDRO actually is.
I'm a board certified family law attorney, so I've been doing divorce litigation since the late 90s. I realized that QDROs and retirement division, military division, things of that sort was an untouched task. So I started kind of specializing in that, doing consulting with other attorneys around Louisiana. And so I started doing a lot of QDROs for divorces parties. And I literally was at a restaurant with a financial advisor friend of mine. We were just talking and chit-chatting, and an idea, he made a comment, and literally at a Bonefish Grill came up with the concept of, why can't you do the same thing for divorce, for married parties that I'm doing for divorcing parties, to be able to transfer and control the funds better. And that kind of literally how the whole epiphany concept of the In-Marriage QDRO came up.
All right, so I think we should define what is a QDRO. We're saying QDRO, and I love somebody was saying QDRO. I said you can just say QDRO. What does QDRO stand for?
It stands for Qualified Domestic Relations Order. So in the divorcing set point, when you have a property settlement after divorce, if the husband has $600,000 in his 401k, or the wife has money in her 401k or 403b, it's how to get funds from one party to the other party without it being a taxable transaction. And you got to meet all the requirements of the ERISA code and tax code and things of that sort. So it's kind of a niche that not every family law attorney gets into because of all the extra requirements and things of that sort. And so the In-Marriage QDRO has been able to come up with a spousal contract that triggers the same federal statute in order to get access to the funds.
Gotcha. So this is traditionally, just so I and the audience understands, traditionally this has been a tool used for couples that are in a divorce, right?
Correct. I would think prior to when I started doing some of this around 2016, if you Googled, I don't think you would have found a single example of it being done during the marriage.
Yeah. So what did you figure out within the tax code that allows this to be used for couples that are actually still married? What's the nuance there?
I Googled the definition of alternate payee while I was at that restaurant, and it said the definition, and I'd seen this definition for 15 years. every single time I did a quadro, 2,000 times prior to that.
Yeah.
But it said alternate pay is a spouse, comma, former spouse. Well, former spouse is the
Yeah.
one that you're divorced from.
Right.
Spouse is your current spouse.
Yeah.
And so that was kind of like the first seed. And then I just started doing a bunch of research. Did them only with one advisor in Louisiana with local clients for 2 years, went through 2 tax cycles, make sure there were no bugs. I wasn't missing anything. And, after 30 of them, I was like, maybe we can start a business doing this wider. So I started kind of contacting other people and going from there.
Well, obviously it's positive for business, right? Because there's more clients out there. But I got to say, it's got to be more fun to help people that are still married, take advantage of a positive financial
Yes,
situation than dealing with it on the other side, right?
that's exactly right. Yes,
Yeah.
exactly right.
Wonderful. So, all right. So we've talked about what a quadro is. I guess, the big question is like, why would anybody consider doing this? I will say, let me back up a little bit. We've talked a lot on the podcast over the past several years. And I've not been shy about this. I'm not a huge fan of 401ks. And, if you do the math, I think, a lot of investors don't understand that if you put your money in a 401k, you save tax today. So if you are paying a 25% effective tax rate today, actually it'd be marginal tax rate technically. So let's just use 25%. And you put your money in a 401k and you earn 10% and you take it out tax free. You have a certain amount that you can take out after, say 20, 30, 40 years. But if you paid that same amount of tax today and it accumulated at 10%, and then you didn't have to pay tax in, that 20, 30, 40 years, it ends up being the same amount of money. So, the bet that you're making when you put money into a 401k is that your tax rate in the future is going to be lower than your tax rate today. So I always like to ask investors, do you think you're going to be poor, in the future or not? And some people say, yeah, my tax rate's going to go way down, but a lot of people, especially successful business owners, people that have been successful investing, they say, well, I don't know. And I don't think the tax rate is going to go down. I don't think it can't. Like, we actually need to raise taxes about 50% just to balance the budget today. So if your answer is no, I don't think I'm going to be paying less taxes in the future, it might not be a great decision to put money in your 401k. The other disadvantage is you've got to wait until you're 59 and a half. And I've got to,
They're just more contingencies. They're just
yeah, there's
more
all
contingencies.
these rules. So I guess, I'm kind of answering the question ahead of time, but why would somebody want to go through this process in the first place?
I mean, I can give you probably the top two or three.
Yeah.
The first one, the first financial advisor that I was telling you about when I came
Yeah.
up with the idea, he did alternative investing. So
Yeah.
he was one that would start putting funds from a 401k into a self-directed IRA and buying real estate or buying these you can buy credit, you can buy debt, you can do
Yeah.
gold alternative investing. Now, some people like that, some people don't like that, but you couldn't do it without doing the In-Marriage QDRO, getting funds. So that's one. The other way, which is probably the most common, is if you have an older spouse and that will be eventually that married to a younger spouse, you could take
Mm,
funds from your 401k and roll it down into the IRA of the younger spouse, say 6, 7, 10 years, and it delays the
oh, interesting.
RMDs.
Oh, interesting.
So
So let's dive into that a little bit. So you're saying, so let's say you have somebody that is, 60 that marries somebody that's 40, for instance, and they're both, you're saying they both have 401ks or IRAs. Is that a good
or just one
example?
of them, or just the older.
Oh, just the older. Okay.
Correct.
So what you're saying is you could actually take those funds and move them in between IRAs or 401ks?
It's not RS for right. Move it from the older spouse's 401k to the younger spouse's IRA.
Oh,
So
interesting. Yeah.
so let's say the R. Well, when I started this, the RMD age was 70. Now it's 72 and something.
Yeah.
But let's say they're 67 Well, in 3 years, they're going to be having to pay it. So let's
Yep.
say they're married to somebody that's 55. They
Yeah.
can roll it down and delays it for 18 years.
Yeah. No, I like that. And I'll give you a personal example. My stepfather's going to be 72 here, shortly after this podcast airs. And he has multiple other sources of income, annuity, rental income, some other stuff. So if he took his required minimum distributions today, he's going to get income that he doesn't need at the moment, but he's going to have to pay tax on that income. So you're saying that, someone like that could move that money down to their spouse, delay the RMDs and delay the taxes, and basically
That's right.
keep that money growing, but spread out the income over a longer period of time.
Correct.
That's
Correct.
okay, terrific. That's something I didn't even realize.
And then the
Yeah,
third primary reason that people do it is to get it to take advantage of the exemption. Most people, if you ask 10 people and say, look, I'm 48 years old, I'm 52 years old, and I want to take money out of my 401k, they're going to say, oh, you're going to be penalized, right? The
right.
10% early
Yeah,
withdrawal penalty. Well,
absolutely.
divorce attorneys, specifically quadro divorce attorneys,
Yeah.
have been utilizing an exemption in the IRS for 30 years, where you don't pay the 10% penalty, even if you
Hmm.
liquidate before age 59 and a half.
Okay, so we're really going to dive into that. So how does that work?
So again, in divorce cases,
Yeah.
you would do, like, a lot of times, sometimes people have debts when they finish divorces, or you got to finance, those terrible family law attorneys, and stuff like that, right? But you can get access, or they're just starting over, right? They have to buy a second house or whatever.
Yeah.
Well, when you have it, you can actually liquidate from the quadro
Hmm.
and not pay the 10% penalty. You pay the tax because it's pre-tax, but you don't
Yeah.
pay the 10% penalty. And if there's Roth,
Gotcha.
you don't even pay the tax inside of the 401k, right?
Say that
So,
one more time.
and if
If
there's
there's
Roth component or an after tax component, extra
Gotcha.
big down in Louisiana, right? So
Yeah.
some of them have after tax income,
Gotcha.
or after tax. And so if you can do it for divorcing parties, which we've been doing for 30 years to
Yeah.
kind of help people get started again after divorce, it's the same exemption for a in-marriage quadro. So you
I
literally can do
yeah.
this, get the funds, pay the tax, or do a tax withholding. You don't pay the 10% early withdrawal penalty.
I love that. So going back in reverse, you can move funds, not pay the 10% penalty. You can move funds from one spouse to the other and spread out your income over a period of time.
Yeah.
Um,
And you can actually do it. You could do it in two
yeah,
seasons. We did one up in Washington a couple of
yeah,
years ago where they wanted to liquidate multiple hundreds of thousands. We did one in marriage quadro in started in October, liquidated it in December, started another one in December, liquidated it in January. So it
yeah.
was divided into two tax seasons, but within 12 weeks, 3 months, he had liquidated multiple hundreds of thousands of funds. Now he paid taxes, but that's his own. He has to get with his CPA. I don't give financial advice or tax
Right.
advice,
Yeah.
but he had plans for it, and of course, it just coincidentally it was that company, and his company, public company, the stock went down. It was right before 2022. So in addition to doing that, he had just lucked out because the stock tanked right after that when the 2022 stock market started to go down.
Yeah.
So
Yeah.
he
Yeah.
ended up saving a ton of money by
Yeah.
liquidating it.
Yeah, that's fascinating. So yeah, I think you definitely got a lot of people's attention here. I'm sure some are thinking like, okay, this sounds great, like almost too good to be true. What are some of the downsides that you've seen, Marcus? You said you stress tested it for a couple of years. Has this been litigated in tax court? Like, have we seen
No,
have we
it
seen
is
this?
not because
Yeah,
because it's agreed upon. It wouldn't be litigated in tax court.
gotcha. Yeah,
There is. And I can give you all our statistics. We probably get about, I think right now our statistics is about 93% of them are approved by the judges. And you say, well, which one? Well, every once in a while, a judge, because it's so niche, a judge will say, I don't have jurisdiction. Now, I think they're
gotcha.
wrong, but we've come up with a policy where we refund a majority of the client's money because you're just not going to convince the judge, right? And this is not an acrimonious situation, so you're not going
Yeah.
to want to appeal or challenge the judge, or so if we're batting 93% from a business perspective, for
Right.
us, it's
Yeah.
easier just to refund one out of every 14 clients money,
Yeah.
and just refund their money so that they don't have upset people.
Gotcha. Gotcha.
So
Yeah.
there's not going to be a tax litigation.
Gotcha. Okay. So you're not going to increase somebody's risk of audit or something like that if
I
if they're
can't. I
going through
mean,
this
it's
process.
been now since 2014, and I've not heard a single person get an audit. So
Interesting.
it's
Yeah.
possible theoretically, but I can't see why.
Gotcha. Interesting. Okay. But there is a chance that this has to go, just so I understand, this has to go past the judge for
Yes.
for a thumbs up. Gotcha.
Yes, it has to be signed off by a judge. And so the only big risk is this is an actual transaction, right? So
Yeah.
if one party's transferring funds from one to the other, depending on the state, community property state, not community property state, we've done it in both, but this is an actual transaction. So
Yeah.
if they're transferring money and then somebody divorces the other one a year later or 5 years
Oh,
later,
gotcha.
I'm not sitting here telling you exactly what's going to happen. All I know is there's a risk that you may be given up control and or interest in property if you're going to be divorced some years in the future. And although most of the people we deal with, I've only out of multiple hundreds, I've only heard of one that came through the grapevine being divorced. So I'm sure there might have been others. I hadn't heard about them, but it's an actual transaction. This is not a simulation. It's not
Right.
a fabrication. It's an actual transaction.
Yeah.
And so people need to be aware of that risk.
Gotcha. Interesting. Yeah, I'm kind of chuckling because it's like, yeah, I guess if you give your spouse money and then they leave you or you guys break
Yeah,
up, then yeah,
it's death and divorce. Those are literally the
sure.
only two risks.
Yeah.
And a
Well, and
bad
those
financial advisor, but again, that's not while you're doing it, that you would assume that they would get to me before they get past that. So I don't worry about
yeah.
that.
Yeah. Well, hopefully, yeah. So before you call Marcus, you definitely want to make sure that, you got a good relationship, you guys got a
Exactly.
good plan, you got a good advisor and you go
Exactly.
through that process and deal with it. Um, Interesting. Yeah. So one of the things we were talking about before we hopped on was, like what's kind of like if you can condense this down, um, you know, early access, early conversion, people can take control back of their money so that they can potentially, because I know a lot of investors, Marcus, they've been successful in their careers. They've got several $1 million in their 401k. And they're like, man, I'd really love to put this money to work in some alternatives. They set up like self-directed IRAs, but this is another step to that where they can potentially, gain access or make it
Getting
more
getting
tax effective.
getting access, one of the probably the most popular recently. It started out, as I said, the first two or three, but I would say the most recent example we've had in the last 5 years is kind of converting to Roth funds, because you can get access to the funds without the 10% penalty. You can take some of those funds or roll it over to your spouse's IRA and let them do Roth conversions to take advantage of paying the tax without the
Yeah.
10% penalty, and converting and putting in Roth IRAs or
Yeah.
self-directed IRAs or other types of investments,
Yeah.
so that you kind of get rid of the tax so that the funds grow without that tax difference.
Yeah, I love that. So that's really you're kind of taking the philosophy that we talked about in the beginning of the show here, which is, if you want to gain access to your money and you want to gain more control over it in a qualified plan, not only does this potentially do that, but then you can take it a step further and put it in, say, a Roth IRA, so you can, safeguard it, hopefully to an extent, unless the tax law changes, but hopefully safeguard that from those future tax implications that you may have.
Correct.
Gotcha. And
Correct.
there is, we've got, if you're listening and you're like, well, how do I do that? Reach out to us, reach out to me at chris@nextlevelincome.com. We've got several groups that you can contact and that can help you, with that tax strategy. Marcus, the one thing is, I think, this has definitely raised, a lot of questions, from our audience, from listeners. So we don't do this that often, but we're going to set up a webinar in conjunction with this podcast. So,
Great.
this this podcast is going out, we're going to do another webinar, and we'll have the info along in the show notes here. So if you're listening here and you say, hey, this is really interesting, I'd like to learn more, go ahead and click below for that webinar. And also, we've set up a special link at your website, Marcus, InMarriageQDRO.com/NLI for next level income. That's InMarriageQDRO.com/NLI. And you can go there, learn more about Marcus and his group and how they can help you if this is something that you're interested in. Marcus, anything else you'd like to add before we wrap up here today?
I will add one more thing that'll kind of blow your mind, because again, when I started doing this, I'm not an estate planning attorney. I'm not a financial advisor. So I was taught applications by people as you get experience. And a lot of it's, can we do this? And it's like, all right, well, let's investigate, right? So the one that I always use, the most exciting one, is this was primarily written for 401ks, 457 plans, 403bs.
Yeah.
But somebody asked, can you get cash out of a pension? And so we did one where not every plan, but some plans allow lump sum quadros. So we did one, an executive at this national company. He was still 5 years away from his retirement. And so we were able to go and take over $1 million out of his pension, not his 401k, out of his pension, let his wife convert that to a lump sum IRA rollover, and then start doing the Roth conversions literally from his pension.
Wow.
That's
so very interesting.
You wouldn't even have been thought about that, instead of it just being sitting there in his pension. So there's a lot of stuff that even when I first started, I wouldn't have thought of, but you kind of just see if it fits and if there's any other applications out there.
Yeah, that's wild. So if you're listening and you've got any of these scenarios that we've talked about, including pensions now, that's another interesting way. And I love what you just said. You don't look at the tax code and say, oh, this isn't what we do. You can say, wait, can we apply this to this situation in a way that's compliant, and then see if it applies to your situation to optimize taxes.
Correct. That's exactly right.
Marcus, this has been great. I've been very fascinating to me. I don't know if we'll be using it, my wife and I, but because we kind of the ship sailed on a couple of these things, but certainly something I wish I knew about a little bit earlier. But thanks for taking the time and sharing what In-Marriage QDRO is with our audience today.
I appreciate it. Thank you, Chris.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.